Hey gang, yeah, so we're live now, a minute or so, 30 seconds early. It's Kam Brar here with Auxilium Mortgage. Well, first, while we're waiting for a few people to jump on this live session, of course, this is open to anybody. Anybody can join us. Who are we? I just want to kind of tell you guys a little bit about ourselves. Again, my name is Kam Brar. I'm the owner of Auxilium Mortgage Corporation. Auxilium simply means to care, aid, assist, and support. That's what our name means, and you know what? We do that here day in and day out. I've been in this business since 2008, and that was at the beginning of the subprime meltdown. In 2011, we opened up Auxilium Mortgage, and we've been in business at the same location in Victoria now since, like I said, 2011, 12 years. In that time period at this location, we've now done over 816 million in funded mortgages, so a fair amount, over 2,000 mortgages. 1,000 plus very satisfied, happy clients, lots of positive online reviews. That's what we do here at Auxilium Mortgage. Now, for those of you not familiar with what a mortgage broker does, it's pretty simple. Our job is to shop the marketplace for you and find the best option. These days, it's all about saving money. I mean, everybody is interested in saving a few dollars. And if it's at all possible, we're going to be able to work at trying to point you in the right direction where that can happen. I guess really what else? Today we're going to be talking about mortgage renewal versus refinance in times of high interest rates. I'll kind of outline the differences so you have a bit of an understanding of what it's all about. As always, we are always happy to have you chime in on what you think some topics should be. Let's face it, financial literacy is your ticket to freedom. I mean, unless you understand how money works, money's going to own you, and you'll be working for it. So it's really important to figure out strategies and ways that you can leverage what you're doing, your hard work, and turn it into something. And we know that typically everybody wants to be a homeowner. It seems to be something that people really have a desire to want to do. I mean, I don't know, it's in our DNA, I guess. Folks are looking to figure out how do they become a homeowner. And I think while that's certainly an important step, one of the very important things that you have to consider is that once you become a homeowner, what is the ongoing cost? What is the, what do you have to kind of give up, or what kind of things are you committing to? And those are things that you should understand really well as well. So, like I said, feel free, chime in with any topics that you have for us for future Facebook Lives. And they don't have to be necessarily mortgage related. It could be things on finance in general, or could be things related to credit, whatever. We are here to hopefully cover a broad range of topics, work to increase not only your understanding of finances, but bring up that level in general, so that way we all are a little more savvy and a little more astute. Anyway, let's get into today's topic. Like we said, we're going to talk about mortgage renewal. So first off, what is a mortgage renewal? Well, typically in Canada, mortgage terms run anywhere from 6 months up to 10 years. That's the term of the mortgage. Now that differs from what is called the amortization. The amortization is think of it as the extended period that a mortgage runs. Actually, you could even think of it like a lease. If you lease a car, for example, typically you'll have a 2, 3, 4-year term, and then you have a buyout at the end. There's this balance still owing. An amortization effectively achieves the same goal. It allows you to run the term, and then at the end of that 1, 2, 3, 5-year term, there's still an amount owing. And that can be refinanced again and stretched out and follow along the original, let's say, amortization. Now, when your renewal is up, let's say you took a 5-year mortgage, and 5 years ago, let's assume, rates were 3%, whatever the number is. Your mortgage, when it comes up for renewal, you have a couple of options. You can stay with your existing lender, and typically your existing lender will, usually about 90 to 120 days, in some cases even before that, will send you out a new offer. They'll say, hey, we can do X, Y, Z here. This is what we're offering. These are the terms. These are the rates. And they'll give you all of those options, so you know exactly what you're facing. Now, normally, if you've had a good repayment history with your existing mortgage lender, there's been no issues whatsoever, they will simply just mail you out that renewal or email it or whatever it may be, and you sign and you're good to go. There's no requalifying. There's nothing you typically have to do. They're not usually looking at your credit in these situations. Again, that's all driven by the fact that you've done everything as agreed. You made all your payments on time and you're a good borrower. And that's just what happens. Now, when your mortgage is up for renewal, you've got some other options as well. If, for example, you had at the time basically, let's say did a high ratio mortgage, for example, then at that point, like I said, so let's say your mortgage was CMHC insured, so you had paid a CMHC premium. In other words, you had less than 20% down and your mortgage is now up for renewal. You now have some new options. Previously, I would have had to qualify you on the stress test even if I took you to another lender. But now we can waive that. If your mortgage was previously insured and you haven't changed the amortization, you haven't refinanced or done anything else, we can now take you to another lender and qualify you on the actual contract rate. What this means for you is it opens up more options. You don't necessarily now have to stay with your existing lender. Again, you've got some additional choices here, which are really, really important. The thing that a lot of people get confused about is the stress test and all of that stuff. So, for example, in Canada, we have what's called the stress test. And what that factors in is it's either the higher of the Bank of Canada rate, which right now is still 5.25, or your contract rate plus 2%. So, for example, let's say a 5-year mortgage right now is 6.5%. When we qualify you, we would qualify you at 8.5%, and that's if you were doing a refinance or pulling equity out of your property. But if your mortgage was insured, like I said before, and let's say the rate was, 4.99 today, well, that's all we have to qualify you on. So bottom line, simply put, you have more options if your mortgage was previously insured, you haven't changed the amortization, and you're not looking to pull out any additional funds. We can explore those options, and if none of those options work out, well, the good news is you can still stay with your existing lender. You don't have to move your mortgage, just stay put. And our time and effort we put into figuring this out for you, there's no charge for. We just provide that service. Okay, now fixed, variable, or blended. Now that's another thing. A lot of people are debating these days and saying, hey, well, what kind of mortgage should I take? Should I be taking a fixed? Should I take a variable or a blended? Well, let's look through all of those. Fixed mortgage rates, obviously we know right now are pretty high. When I first bought my first house, and now I'm probably dating myself, in like 1992, rates were around 7.5%. When I got into the mortgage business in 2008, rates were around 5.5%. Now, right now, if you have an uninsured mortgage, your rates are typically around 6.5%. If you have an insured mortgage, we have a lender right now offering 4.99%. So that's kind of the range rates are. So that's the fixed. The advantage of the fixed is your rate stays guaranteed for the 5 years, 4 years, whatever term you choose. So there's no risk for you rate-wise. Now, of course, you can take a variable. Right now, we know that the Bank of Canada prime rate is pretty much been the highest it's been in quite a while. So the variable right now typically will either come with a discount if you have a variable, and if it's a home equity line of credit, it usually will have a surcharge on the Bank of Canada rate. Again, the discount will vary lender to lender, situation to situation. We have some lenders that are offering a discount of over 1%, while others may offer only 0.5%. Again, depending on your situation, we can take a look and see which lender would be best. Now, some of you may be wondering, well, both of those sound really good. Is there any other option? Yeah, we can do a hybrid. We can do like a blended model where some lenders allow you to have, let's say, portion of it in a fixed, portion of it in a variable. Some people can even stagger. One portion could be a 2-year, one could be a 3-year. I mean, again, there's a myriad of options depending on your strategy and what it is that you're trying to do. So that is with respect to fixed, variable, or blended. Now, the other question that comes up a lot right now is, should I take a shorter term? I mean, the prognosis is, and again, it depends which so-called expert you listen to, the prognosis is in the next year or two, rates may be dropping. How much? Hey, if I had a crystal ball, I wouldn't be here. So we don't know how much they'll drop. But typically what happens is when things go up really high, we know they typically retrench and give back a bit. So even if it's 0.5%, 0.75%, whatever, anything is going to be lower than what you're paying now. So if you do take a shorter term, let's say, for example, a 1 or a 2 year, that would be advantageous if rates do move up when the renewal is up, and they could be to your favor. Now, is there a downside to taking a shorter term? Yeah, there's a couple of things you should consider. Number one, what if rates go the other way? That could pose an issue as well. The other thing that can happen is something could change with your job, or let's say your credit or whatever else. A myriad of things can happen during that time. The good news, as I mentioned to you before, is if you've been making your payments regularly with your existing lender, done everything on time, normally they will just simply renew your mortgage. So that shouldn't really create, hopefully, too much of a risk for you that way. So that's certainly an option. Now, the other thing is when we look at mortgages, what happens is there's a difference between mortgage refinancing. So like we said, we've been talking about renewals so far. Renewals are typically when you just renew with the balance that's left, keep on the same amortization, and take a new term. Now, refinancing is a lot different. Those are times when you may be wanting to pull money out for something. So you may want to be doing a home renovation. Maybe you've got debt to clear up, or some of you may want to invest in RSPs and want to borrow money to put into RSPs. Whatever they may be, the moment you start pulling out money out of your equity, out of your property, it's considered a refinance, and things totally change. At that point, you would get offered different rates, different things that their lender is now going to look at. Now, what some people do is, instead of opting to put everything in one new mortgage, some people with a refinance will add a home equity line of credit, and they will add that additional debt or whatever option they're looking for into that versus adding it to a traditional first variable or a fixed rate mortgage. Again, I know this might sound a little complicated, but best to get a hold of us. We can walk through your situation individually. Now, when it comes to refinancing, you must understand that with the rules we have today, the maximum loan to value lenders will allow you to go is up to 80%. So if your house is worth $1 million, the max you can borrow, provided of course your debt servicing ratios all fit, is up to $800,000. In that case, basically that magic 80%. That is what the rules are, and that's what things are restricted by. Now, we do have sometimes lenders that will go beyond that. Those are alternative lenders, and again, that's on a case by case, but not much more over that, and very few lenders who will do that. And that would be what would happen in a refinance type of situation. Now, refinance rates these days, you can expect them somewhere, 5-year terms are kind of in the low to mid sixes. That's kind of where they're running, and they do fluctuate. Now, we usually with a refinance, a lender may require you to do an appraisal on the property to support the value. If you're doing a straight renewal, no, typically not required at all. It's just basically switching over to a different lender. So hopefully that has answered some of those types of questions for you. Now, the question is, should I switch lenders? Well, if you're going to switch lenders, things that you have to take into account are potential legal fees, appraisal, all those sorts of things, and they should be figured into your overall cost. If, of course, after doing all of that, the savings are worth it, absolutely, by all means, you should definitely look at that. And that's what we do. We'll look at your overall situation. We try to go from front to back and make sure that if you're going to do a switch or something like that to a new lender, and that's another thing that is called sometimes, it's like instead of the mortgage renewal, some terminology that some brokers and banks will use is they'll call it a switch transfer. Again, you're just switching or transferring your mortgage to a new lender, same effective amortization, new term, same balance, that sort of thing. So again, the language is that. The only time you ever have to think it's anything different is if you're A, extending your amortization, B, you're pulling out funds for anything else like that. In those situations, like I said, it would be deemed to be a refinance. Hopefully this has shed some light on things for you. Again, we do lots of that here at Auxilium. And I know that the typical calls we're getting these days are people who are struggling with their current debt load. They may have a lot of ancillary debt, and that's the advantage of a refinance. Sometimes with a refinance, it makes sense to add that additional debt in, and sometimes it doesn't. It really just comes down to your individual situation. We can take a look at that for you. I know we've also received many calls in the last 2 months especially from folks who have got a really great rate on their first mortgage. It's super, and they've still got maybe 2-3 years to go. However, they've still got all this other debt they've piled up. They'd like to deal with it. Again, in those situations, we've got a great solution. We can look at a second mortgage for you in that capacity. That way we can wrap up that level of debt added to that, and you can still effectively keep your great first rate. Now, those lenders I have typically for second mortgages, I've got lenders who are not going to apply the stress test at all, and they've got relaxed debt servicing ratio. So a solution might be easier than you might be thinking right now in those situations. So, and I guess one other exciting product we've recently gotten access to is it's basically a payment eliminator mortgage. This solution allows clients who have equity in their property to borrow up to maximum of 40% of the equity. So again, let's use our house of $1 million house, for example. We could, in that situation, get a client up to a $400,000 mortgage, which has the option of no payments having to be made for up to 5 years. Now, that doesn't mean that interest isn't accruing. It is, but you're not being asked to make payments. And the other advantage of that one also is the fact that this product is not restricted by age. It doesn't matter how old you are. It's just looking at that magic 40%. Now, it's not right for everyone, but for some people maybe that are struggling with a lot of cash flow problems, this could be the ideal fit for them. And like I said, we do care about your credit. It doesn't have to be absolutely stellar. It has to be decent. And again, this product is also not driven so much by your income. Some of you I know are self-employed. Some of you don't always file all your income. Some people, do a lot of cash jobs, whatever. This product is geared toward looking at all of that, and it can also use rental income. Again, the downside to this product, well, simply put, the rates are a bit higher than traditional rates. But if you're looking for cash flow and that's really what's hurting you, this is a great fit and solution. Anyway, I hope this has been informative. We try to keep these sessions short and sweet, cover a lot of different topics. If out of all of this you've got some questions that come up, don't hesitate, give the Auxilium team a call. Auxilium simply means to care, aid, assist, and support. Our team, our brokers here, we've got oodles of experience, lots of good reviews, and whatever your situation is, we'll figure it out. We'll work it, we'll work it out together. And if at the end of the day it seems that staying with your existing lender is the best fit, well, then so be it. At least you know you've explored all your options and have been financially savvy. Anyway, I thank you for joining us. I don't think we have any questions. Maybe I've answered them all today. We've kind of gone through the gauntlet of it, but like I said, don't feel like this was the only time. If something comes up later on, you're watching this video maybe at a future date, this live session's been over, and you get anything that pops up in your head, send us a question. We'd be happy to assist you. All right, we'll see you next time.